Welcome to the McLean Syndicate Real Estate Market Outlook for October 2025. We are going to look at capital markets, assessing the asset classes, some policy and cost issues, and then summarize. First, we'll look at capital markets. Familiar story by now. We had very low interest rates in the period right after COVID. Keeping those rates down fueled inflation, also investment. Then we had rapid increase in rates coming after the COVID pandemic. We've seen them peak out in 2024 and come down a little bit here in 2025. Not huge relief, but people sort of getting used to elevated rates and getting deals done with the current environment. These rates are actually, you could argue, a return to normal after we had very low rates, sort of 2008 to 2020 timeframe. So a little bit of returning to historic long-term trends, but obviously an adjustment from the low interest environment we all enjoyed in the 20 teens. This graph showing the inflows, responding to the rates as rates went down in 2021, 2022. We had huge investment into commercial real estate across most asset classes, and that really has curtailed since rates went up 2023, 2024. Um, Office, obviously some variations in the asset classes, and we'll get into that in a minute here. Office being a standout for limited investment, once the effects of COVID and work from home and demographic shifts kicked in. Current lending environment, we can see what's favored. I mean, multifamily and industrial have been standing out. Some cracks in both of those we'll get into, at least on a regional level. Office, very challenged, and then hospitality kind of mixed depending on where it is and what it is. But current rates and sort of risk outlook summarized here in this table. Digging into the asset classes, we'll take a look at multifamily first. We can see vacancy rates really creeping up the past couple of years, now nationally at 9%. Rents sort of flat this past year. And we'll see, also some regional variations in there. Completions coming online, falling off significantly in 2025 as a result of sort of oversupply issues. So here's where the story starts to crystallize. Recent, this year really we're seeing kind of a flip in the trend. I mean, for a long time we've just seen investment pouring into the Sun Belt. Occupancy rates down, rent growth high. And that story is really starting to change. We've got Dallas and Phoenix really peaking up at very, very high vacancy rates compared to New York and San Francisco. And yeah, you might want to double check that, but that's the story. New York rates down at historic lows, even San Francisco coming back on vacancy rates. So a very different story, basically driven by oversupply in a lot of these Sun Belt markets. Industrial, also really suffering from an oversupply. You can see the orange bars here, construction completion, and this was, sort of known, I think, but no one was maybe in a position to stop it or to get out in front of it. So we have a lot of this, e-commerce infrastructure coming online, and a lot of it needed, obviously. But then you see, as that supply is delivered, vacancy rates going up, and not sure how long that is going to take to fill up in the medium term. So definitely softness in that market. Um, the Vacancy rates on industrial showing a similar story, at least in these examples we pulled for multifamily with, Sun Belt again, really showing weakness, really showing the results of oversupply, and, historic older market like Chicago now coming down quite a bit and practically half the vacancy rate of some of the Sun Belt cities. So quite a different scenario than what we're used to, and some interesting trends coming out here in the latest data. Looking at offices, just a real problem here, structural issue, not going away anytime soon. National vacancy rate up above 20%, rents flat. And online supply or new supply coming down to almost zero now, negative net absorption. So real structural issues in the office market, and some caveats, but and some conversions of office to multifamily. Not sure that's a systematic solution, but can work for some projects, and we'll see how this plays out over the coming months. Regionally, not a lot of differentiation or any signs for optimism. I mean, San Francisco coming down off its peak of more than 34% vacancy, but not by much. Dallas coming down a little bit, but this is really across the board, just high vacancy rates and trouble, filling especially those older buildings without the amenities, and what to do with them, and how to what to convert them to, or some other use for them is a huge question that needs to be addressed. Hospitality, we saw a big bang rebound from COVID. Occupancy rates much higher, still not back to pre-COVID levels. But revenues certainly back up there above pre-COVID days, as well as ADR. We see that growth rate come down from 2023 to 2024. Now is really stabilizing at kind of a long-term trend. Um, and we'll see some variations in regional markets. I mean, vacancy rates coming down across the board, but some quicker than others. Again, New York kind of, one of the leaders among larger metro areas, coming down at 15.5% vacancy now. Orlando staying up there, 24%. So again, really one of the themes here is just weakness in the Sun Belt and kind of the rebound of some of the northern and coastal cities. You can see in the table, occupancy rate, New York 84%, Atlanta 65. So also another Sun Belt sort of indicator of weakness, as with multifamily. Looking at some policy and cost issues, of course, been kind of a roller coaster year with trade talks, tariffs, and lots of other issues with the new Trump administration. Um, the risk here of the tariffs really driving up prices and costs in real estate is there. Too soon, I think, to make a call on sort of even medium term, because we've seen some results from these negotiations, for example in the auto industry, where we've got essentially lower tariffs overall. So it's still not clear how much of this or which of these tariffs are part of a negotiating strategy versus sort of a permanent policy. And so until these trade talks kind of shake out, where I think it's too soon to call the sort of permanent effect. But obviously a lot of jitters in the market. On the plus side, opening up real estate and private markets to 401k investments obviously could increase the level of investment, and then huge national policy focus on AI and data centers is moving that market. I mean, another caveat, sort of locally, more opposition building to the data centers and issues in utilities. But really need to dig into that industry specifically to understand all the different cross currents there. Costs, just to point out here on the pie chart, labor is the largest cost going into commercial real estate, or construction. So anything that's driving those costs up is likely to have a major impact on the industry. Um, Across the board, we've seen price increases over the past year in a lot of the inputs for construction. Again, how much of this is temporary in terms of trade negotiations and disputes versus sort of permanent, we don't know. In issues like steel, we've got some counter currents with the U.S. Steel Nippon Steel deal, which could bring efficiencies and drive costs down. So you know, short term, definitely turbulence, definitely some price increases, but not clear that those are permanent. We see employment and average wages on this graph. Average wages sort of flattening out earlier this year. Employment coming down a bit, but again, this is a lot of this is transition from previous presidential administration, and a lot of short-term uncertainty. Just have to wait and see how all this plays out. So, in summary, obviously overall a rebound from COVID days, minus the office asset class. Lots of signs of weakness in the Sun Belt. Just the story of oversupply seems to be pretty much across the board in the Sun Belt for multifamily, for industrial, for hospitality as well. So I think tough time for investors in that market and owners as they wait for that oversupply to sort of be taken up and filled. Good times generally, I would say, for some of the older cities that were hit hard during COVID, New York and San Francisco in particular, with low vacancy rates in multifamily, hospitality, and other areas. So that's essentially the story we're getting from the latest data. We are the McLean Syndicate. We offer capital raising, M&A, and other financial advisory services. We work across sectors, not only in real estate, but in several other sectors. I'm Brian Deslets. I'm the managing director of the McLean Syndicate. If you've got a need for capital, please reach out and give us a call. Thanks very much. Bye bye.